Hello and welcome to Successful Real Estate Strategies. My name is Joe Larkin from Denver, Colorado, and today I want to review what are the options that an investor may have when considering selling an investment property. First of all, I want to make sure that I am not giving any legal advice and or financial advice in this video. You do need to seek an attorney or a financial consultant for your individual needs. So what we're looking at is a counseling assignment for investment real estate. And I like this photograph of a building under construction because it reminds me that anytime you get involved with real estate as an investor, even as a tenant leasing, you should always start with the end in mind. What is the exit program as your investment strategy? For this video, I put together a small case study. And the situation of this case study has to do with a past client. Our past client received an unsolicited offer to purchase a multi-tenant office building for $10 million. The building was acquired by the past client 5 years ago. It is not on the market for sale. However, the past client has been seriously considering selling the property and buying a distribution facility for $8 million. That distribution facility has an A2 rated tenant and has 15 years remaining on the lease. We have now engaged the client, and we're here to help the client make an informed decision. We're going to evaluate all situations, and currently there's no debt on the property. The seller will consider financing, and the seller will consider all possible options. Our scope of work indicated that the initial meeting will be an overview of what the client can do and all the options the client may have. So let's prepare for the first meeting. I like to start every assignment with the ownership cycle. And there are 3 phases in the ownership cycle that we have to pay attention to. The first is the acquisition phase and what takes place to acquire the property. The second is the ownership phase. What can be done during the ownership to increase cash flow, increase income, or increase value? Also during the ownership phase, is enough money being put away in reserves in order to replace capital items such as roofs and HVAC systems? And the third phase is the disposition phase. So those are the 3 phases of the ownership cycle. Let's take a look at the acquisition phase and what takes place during this phase of the ownership cycle. Well, the first thing that needs to be done is establishing an investment strategy. What are the goals and objectives of the investor? What are they trying to accomplish? Is it equity buildup? Is it cash flow? It really is like financial planning for real estate. You're becoming a financial planner for a real estate investment. Overall strategy, is it core plus? Is it development? Is it add value? Different strategies. Also, you need to fully understand what tier is this investor in. I mean, tier 1, tier 2, or tier 3. Are they small investors or relatively large investors and have a lot of experience in investing? We want to take a look at the CapEx, or the reserve for replacement. And what we're trying to do is put money away for a rainy day. So when that roof leaks 5 years out, do we have enough capital set aside in order to replace that roof? We look at pro forma and lease abstracts. And I'll just say that lease abstracting could be very boring. However, it's the most important thing in investment real estate because what you're buying are the cash flows from the lease. It is said that leases are the engines that drive investment real estate. So we take the information from the lease abstract and we forecast out cash flows and also the reversion. The reversion in our modeling is the net asset value at the end of the holding period. Holding period may vary depending on the property and the term of the leases. For this case, we're going to do 5-year analysis. So at the end of 5 years, we're going to look at what is the net asset value, or if sold December 31st, year 5, how much would the investor receive in sale proceeds after tax? We apply the 3 approaches to values. And I'll tell you, the 3 approaches to value is so critical, especially understanding that for underwriting and financing. We look at market studies, marketability studies, and we perform them. They become part of the appraisal process. So it's critical to understand the dynamics of the market and also the marketability of the building. Last, we apply performance measurements, and they'll vary based on the investor goals and objectives. So the acquisition phase, there's a lot involved in it. Always start with the end in mind. I'd like to overview our financial modeling, and it's done on an annual basis. As I said before, with this office building, we're going to do a 5-year analysis. A lot of office buildings, the leases are typically 5 years or less. And so how it starts is that on January 1, we acquire the property. So we look at what is the initial investment, or what is the down payment plus acquisition cost. And then we look at each year, every year, end of each year, and look at what the cash flow is all the way to year 5. So in year 5, we're going to have the cash flow from operations plus the net asset value. Some people call it the reversion, sale proceeds before tax, or sale proceeds on an after-tax basis. So our financial modeling starts off with the initial investment, cash flows, sale proceeds. Again, these could be with financing, without financing, before tax, after tax. And those are the 4 ways that I typically take a look at our cash flow models. So the investor analysis could be capitalization rate. Capitalization rate is a great beginning tool to look at. There's a appraiser in Texas that has determined there are 233 different ways in calculating the capitalization rate. I like to look at the capitalization rate, how REITs look at, and how REITs underwriters look at the cash flows. And they have 4 different capitalization rates they use, and I like to use those 4. Cash on cash, typically that's for a particular investor, especially with financing. We look at yields or IRRs before tax and IRRs after tax. Now, nobody has an IRR after tax. The reason why we do the IRR before and after tax is because the delta represents the loss in yield because of taxation. And so this can demonstrate to our client the fact that cost recovery and potentially interest deductions could actually minimize or reduce down the impact on taxes. We do present value analysis on an after-tax basis and a before-tax basis. And some cool things to take a look at for accumulation of wealth is the FMRR, the financial management rate of return, and a growth rate. So we'll apply these to this analysis to help the client make an informed decision. I like to perform a number of sensitivity analysis on our modeling. One of the first ones I'd like to take a look at, and I ask the question, where is the yield coming from? Is it coming from cash flows, or is it coming from the big pot of gold at the end of the rainbow? And if it's coming from the sale proceeds, I'm going to question our numbers that we're using. At this point, I would look at the purchase price and calculate the annual growth rate to the forecasted sale price and see if that reflects the true market of increase in value. So a lot of sensitivity analysis needs to take place just to make sure that we have a high confidence level in our numbers in our forecast. So let's take a look at the ownership phase, or the second phase in the ownership cycle. And during the ownership phase, what I like to look at, what were the capital improvements, if any at all, that took place during the ownership phase? Did it increase cash flow, NOI? Did it increase the value of the property somehow, some way? Did it increase marketability of the property and appealability for potential tenants to come look at? Those are some of the things that I like to look at during the ownership phase. And many owners during this phase should consider the cost benefit and complete a cost benefit analysis on anything that's being done during the ownership phase. Here's where we're going to take a look at the net asset value. And what I mean by that is this. This owner has held the property for 5 years, and here we are. They have an offer. We want to calculate the net asset value if this client decides to accept the offer and pay taxes. So what is the net asset value of the sale proceeds after tax the owner will receive? And we're going to use that number throughout all of our analysis from here on in. So the question is, what is the sale proceeds after tax and the net asset value if the property was sold today. We then look at continuing to own the property and building the cash flow model. The net asset value would go in time period 0. We would abstract all of the leases and forecast out cash flows, making some assumptions on rollovers, vacancies, and things like that. Then we do the exact same thing. However, what we're going to look at is financing. We're going to apply financing and go out and create an RFP, request for proposal, and find the best financing out there. And we're going to analyze the property if it was financed. Hopefully we can have what's called positive leveraging. We use that money to acquire a second property. So the owner has the office building right now. We calculate the net asset value. We look at continuing to own and not changing anything. We look at, well, what if we finance the property? And I've got some great tools and reports that I put together in determining the best financing on any investment real estate. We then look at financing. We could probably go to Vegas, I guess, and put it all on red, but we're trying to do the best thing for our client here. Or he could buy stocks and bonds. But for real estate purposes, we look at acquiring a second property. We calculate the net asset value of the sale proceeds after tax, and we're going to use that number in the time period 0 calculation. So our model, continue to own, is the net asset value if sold today. And I changed the years around because technically it'd be years 6, 7, 8, 9, and 10, and we sell for sale proceeds. Here we apply the same performance measurements as we did in the acquisition phase, cap rate, cash on cash, things like that. Now let's take a look at if we actually went out and acquired a second property. We borrowed the maximum amount of financing on the office building, took that money and purchased the distribution facility. So we're going to have a couple different cash flows. So property 1, the office building, we have a net asset value in our cash flows and sale proceeds. We do the exact same thing. Now these are going to be after tax with financing. And then we combine them together. And here we start doing a portfolio analysis. And I love doing portfolio analysis for my clients. It gives you a big picture of everything combined together. If you think about it, if you have a retirement fund, what happens? It sends you, your fund has and your portfolio has an increase 15% per year or 10% per year, or the return you're receiving on your portfolio is X. So we're doing the exact same thing. We're creating a portfolio and doing a portfolio analysis, applying the performance measurements to the cash flows of the combined two properties. I can't stress the importance of proper due diligence. There's so much needed to make an informed decision. Property inspections of all the capital items, roof, HVAC, etc. Review of all documents from the acquisition all the way through. Review CapEx items, the reserve program and why it was put together that way. Lease abstract. We need a lease abstract every single lease. Also, take a look at the market studies and marketability studies. And if there are none, probably you should perform both of these. They're so important in applying the 3 approaches to value. So now we enter the disposition phase of the ownership cycle. And what are the choices that the owner has? And right now, the owner really is in the disposition phase, owning the property for 5 years. The owner can sell the property and pay the capital gains tax, sell the property, pay the capital gains tax, and purchase another property. So we can do an analysis on that. So we'll have our sale proceeds after tax, or our net asset value would be the time period 0. Purchase another property, purchase the distribution facility, and forecast out those cash flows and calculate the performance measurements. You can do an installment sale where the owner actually becomes the bank, and we can calculate the deferment of capital gains tax into the future. 1031 exchange is used quite a bit. And here's where the analysis is a little bit different, because the net asset value would be the sale proceeds before tax, and time period 0 would be a little bit bigger than the other analysis that we do. Also, 1031, everyone believes it's always the best choice. Not necessarily. I found that most of my clients and the analysis that I do for my clients indicate that the actual continue to own, finance, pull the equity out, and buy another property is a better choice than 1031. And if you think about it, the reason why is because financing is a tax-free event. Pulling equity out is a tax-free event. Now you have more leverage on a greater value. If you think about it, we have a $10 million property and potentially an $8 million property. Now we're controlling $18 million of assets. Another choice to consider, a DST, Delaware Statutory Trust. Here's where you exchange into a trust and the investor, our client, would receive cash flows forever. Problem with DSTs most of the time is that they are non-controllable. It's outside your realm. However, people are tired of management. It could be a great solution for the client. Next one is the convertible preferred stock, and this is pretty cool. A lot of publicly traded companies are offering 1031 exchange into, and the actual client will receive a convertible preferred stock. And so what does that mean? Well, it's a preferred stock, meaning that you're guaranteed a certain percentage on your investment each year, every year. And if you want to cash out, you can convert it to common stock and sell it on the market. Kind of an interesting way. So it does offer an exit program in as much as the preferred stock is converted to common stock, and the common stock is sold on the marketplace. So some different ways. Again, in disposition phase, let's look at it. You got sell, pay capital gains tax, and buy another property. Not always the best choice. Now, some people have done it and will do it if they believe that capital gains tax is going up. There are a couple times in history where the president has come out, or the soon-to-be president has come out and said, I'm going to double capital gains tax. And so a lot of my clients decide to actually sell their property before that person got into office. So that could be a reason why. Installment sale, that's when the actual client, the seller, becomes a lender and holds a mortgage. There's some benefits to that. 1031 exchange, again, not always the best choice, but many people use 1031 to exchange. The DSTs and convertible preferred stocks, again, all choices in the disposition phase of ownership. So with our case study, our client wanted to have an overview of the options. And right now we should prepare for our next meeting with the client to go over what the options are. The first one is just continue to own as is. We forecast out cash flows, do lease abstracts, apply performance measurements on continuing on the property for 5 more years. The next is to continue to own, however, pull the equity out and finance the office building to acquire the warehouse distribution facility. It's a very, very powerful way of building wealth in real estate. So what we're doing is we're pulling the equity out of the office property, acquiring the warehouse distribution facility, and then we're going to apply performance measurements on both, calculating a portfolio. We're doing a portfolio analysis on both properties. The next is to sell, pay capital gain tax, and buy another property. We'll look at that and consider the numbers on. And the reason why someone may consider doing that is because they believe capital gains tax may go up. We'll look at installment sale as another choice and provide the analysis on the installment sale. And that's deferment of capital gains over time for pretty much estate purposes. We'll look at the 1031 exchange and how that works. And just remember, with 1031 exchange, the net asset value is going to be higher than the other analysis. And the reason why is we were going to use sale proceeds before tax because we're not paying any tax. We're not paying the capital gains tax as being deferred. So there's a little bit of advantage to using 1031. Look at the DST, Delaware Statutory Trust, also convertible preferred stock. Well, I think we're well prepared to meet with our client in the initial meeting, reviewing the 7 options that can be implemented. I want to thank you for watching this video. I do have a number of videos on my YouTube channel. It's called Larkin Channel. Reach out to me, LinkedIn. Also visit my site. You want to find more information about me. And again, thank you so much for watching this video, and I truly appreciate any comments.